Listen, the hardest dollar to invest isn't the millionth, it's the first one. Here's why your first $10,000 feels like an absolute wall, and exactly how you can walk straight through it. Welcome to this explainer, where we're going to break down the exact math, the psychology, and the beginner investing strategy you need for 2026 to finally conquer that first investment fear. We're going to get your money actually working for you.
So let me ask you something right off the bat. Why does keeping your money entirely in a cash savings account feel so responsible? I mean, we're trained from childhood, right? Put your money in a vault, lock it up, and it's completely safe. You log into your app, you see the number sitting there, you feel virtuous, and you feel secure. But here's the catch. What you're actually doing is introducing a silent, guaranteed tax on your wealth. And that tax is inflation. That cash sitting still, it might feel safe, but it's actively making you poorer every single day.
Now, what's really interesting about this slide is the brutal reality of the math over a long timeline. Imagine you took $100,000 and just left it in a standard savings account back in the year 2000. Yes, the nominal value, the actual number on the screen, goes up to around $147,000 today. Feels like a solid gain, doesn't it? But when you adjust for that silent tax of inflation, the purchasing power of that 147 grand only buys what $87,000 would have bought back then. Your safe choice literally lost you money in real tangible terms.
I love how this quote perfectly captures the whole problem. You didn't save money, you stored it somewhere that slowly ate it. It's the ultimate illusion of safety. Seriously, even if you've done everything right, let's say you hunted down a high-yield account earning 4.6%, you are still likely losing ground once inflation takes its cut. The number goes up, giving you this quick dopamine hit of security, but your actual power to buy things shrinks.
And this brings us to a huge emotional roadblock for so many people: analysis paralysis. This is driven by what we call the psychology of first risk. Basically, we drastically overestimate our potential loss. We sit around waiting for a perfect time to invest, a time that, spoiler alert, never actually arrives. You start reading the news headlines, perfectionism creeps in, and you're absolutely terrified the market will crash the literal day after you invest. This analysis paralysis leads to the ultimate beginner investing mistake: doing absolutely nothing at all. Let me show you what doing nothing actually costs. $214. This is the resonant story of Sarah, a 34-year-old who let this tiny amount of money sit completely untouched in a retirement account. She opened it years ago, probably because someone told her she had to at a holiday dinner, funded it exactly once, and then entirely forgot about it. Just sitting there. The password to that account is probably her childhood dog's name, something like Tucker1. Now, that account is a Roth IRA, which is exactly where your first 10K should live for that sweet tax-free growth. But the cash is just parked in a money market fund earning a microscopic 0.01%. This forgotten $214 represents the slow, invisible, and incredibly expensive damage of compound growth working for literally everyone else except you. When you leave money entirely uninvested, you're paying a massive opportunity cost. So how do we fix this? Well, we have to look at the fundamental difference in behavior. It comes down to savers who store versus builders who deploy. Savers take their wealth, lock it in a vault, and, as we just saw with the inflation math, let it slowly decay. Builders, on the other hand, look at money entirely differently. They deploy their capital. They push it out into the market so it can actually grow and compound. If you want to successfully learn how to start investing for beginners, you absolutely must shift your mindset toward what we call deployment velocity. This means activating your money's potential. Every single dollar has the ability to go out and generate more dollars. Cash isn't neutral, you know? It's not a pet you keep in a cage, it's a worker, and it is meant to be put to work for you. And this brilliantly illustrates the long-term impact of deployment. Let's look at two identical starting points over a realistic 30-year horizon. Path A is $50,000 parked in a high-yield savings account averaging 4.5%. Path B is that exact same $50,000 deployed into an S&P 500 ETF, which has a historical average return of 10.1%. Both start at the same time. No extra money added along the way. Look at the outcomes. The difference is absolutely staggering. $180,000 versus $878,000. That is a massive gap. And listen, it's not about natural talent. It's not about perfectly timing the market or having some secret insider information. It is simply the result of the decision to deploy your capital instead of storing it in a bank. If you take nothing else away from this explainer, I want you to remember this. Every year you store money instead of deploy it, you pay a fee. And guess who the primary beneficiary of your idle cash is? The bank. They take your deposits, they lend them out at much higher rates for mortgages and business loans, and they pay you absolute pennies in return. They are making a massive, invisible spread off your fear of the market.
The Action Plan, a beginner investing strategy for 2026. Let's move out of theory and get practical.
Okay, let's dive into this exact step-by-step plan to get you past that hesitation. Step 1, if you haven't already, open a Roth IRA at a low-cost brokerage literally this week. Step 2, choose one broad ETF. Step 3, set up a recurring automated transfer, like $250 every single month. And Step 4, commit to not selling for 10 years. Let time do the heavy lifting. Don't check the account value daily, it'll just drive you crazy.
Now, about that broad ETF, something like Vanguard's VTI is a phenomenal choice. Why? Because it completely eliminates the need for complicated stock picking. It effectively mimics that legendary three-fund portfolio structure by tracking the entire U.S. economy, completely eliminating the single-stock terror of trying to guess which company is going to win. Plus, it has an ultra-low expense ratio of 0.03%. You're buying a tiny slice of everything.
To really show you the power of this strategy, let's look at the concept of indifferent arithmetic with a single initial $5,000 block of capital. You hear a lot of debates about dollar-cost averaging versus just throwing in a lump sum. Well, what the data actually says for nervous beginners is that simply deploying the capital now rather than waiting on the sidelines is what truly matters.
Check this out. If you invest $5,000 at age 22 into a broad index fund and never touch it again, not once, it becomes roughly $160,000 by age 67, assuming a historical 7% average real return. This incredible math just works in your favor while you sleep, while you stress about your job, or while you binge-watch shows on a Tuesday night. It is completely indifferent to your daily worries. Let's move to and see how this builds. Remember Sarah from earlier? She waited 3 long years, stuck in analysis paralysis. But then she finally deployed her first 10 grand in a total market ETF with automated monthly transfers. Over the next 2 years, even through typical market pullbacks and typical corrections, her consistency drove a steady climb. And despite a market dip, crossing that magical $10,000 mark completely shifted her net worth mindset. That is the wall you have to push through. Because when you finally hit that 10 grand, it might just feel like another number on a screen, but structurally, it changes everything. As this quote says, "You have built quietly the first gear of an engine." You are no longer just saving, you now possess an active compounding financial machine.
And here is the best part. Once that engine is built, the silent power of compounding takes over. At a 7% annual growth rate, your $10,000 machine will double itself every 10 years without any involvement from you. 10 becomes 20, 20 becomes 40, 40 becomes 80. This is exactly why you commit to not selling for 10 years. The money itself begins to work harder than you do.
So, what does this all mean for you? The first 10K is absolutely the hardest. It's the tuition for your future wealth. But keeping your money parked in cash is a guaranteed loss to inflation. Pushing past the fear, getting into the market, and staying invested, that is how you buy your future options. It's how you buy your freedom. So I'm curious, if you already made it past that first 10K wall, tell us what got you to finally hit invest. Leave your story below. And don't forget to subscribe for the next chapter. See you next time.